If you were to design the perfect investor from scratch, it probably wouldn't end up being human. I'm not sure what it would be, but the very things that make us most human are some of the things that work hardest against our ability to be successful investors. In the last chapter, we looked at some of the reasons that lead us to failing to plan effectively, and found that a lot of it stems from our own biology, or our default settings. If we don't change our defaults, we're setting ourselves up to fail. The issue here is that planning is very general, and in fact, we plan all of the time. If we can find resistance in something that we all do, then it's valuable to explore what we should expect from something new, like investing. We've already established the challenges that go along with planning, and every single one of those challenges impact our success as investors. If we do everything correctly outside of planning, it's just a matter of time until our lack of planning destroys any progress that we made. Even with an excellent plan, our success still depends on our behavior and our discipline to stick to our plan. For the majority of our time as investors, it'll be really easy to do the right things. For the most part, doing the right things will mean not doing anything differently than our plan specifies. But it won't always feel like that. So the only way to find a permanent solution is to properly understand the problem. Studies over the past couple of decades have found that the news is becoming increasingly negative. This might give you the impression that the world is becoming worse, but that isn't the case. The shift in the news isn't an accident, though. Humans have a negativity bias, meaning that we pay more attention to negative information than we do positive information. Research has found that negative news provokes stronger reactions and gets more attention than positive or neutral news stories. We are drawn to the bad and are more likely to purchase a copy or click a link. This incentivizes agencies to produce negative news headlines because it turns our attention into revenue. But negativity bias doesn't just impact the news we see. In our day-to-day life, we're more likely to notice and remember the bad than the good. It's more likely that a single bad event can completely ruin our day, regardless of how many good things happen in return. Just like with planning, this prioritization of the negative could stem from our evolutionary process. Noticing the bad and doing what you can to avoid it likely led to survival. Although we don't live in the same world that our brains evolved in, research suggests that up to 80% of our daily thoughts are negative, and 95% of our thoughts are repetitive, meaning that we think about the negative a lot more than we think about the positive, and by repeating those thoughts, we're reinforcing that negativity. When we focus on the negative, it can make us pessimistic about anything, even the good things. This can cause us to get discouraged or think that trying to make a positive change in our lives is a waste of time. It can stop us from getting started before we even begin, or stop us from doing the right things after we've begun. This focus on the negative might be one of the contributing factors as to why investors feel the pain of a loss more strongly than the joy of an equal-sized gain. Referred to as loss aversion, it can take many different forms. Loss aversion may make you so fearful of losing money that you never invest at all, or panic at the first sign of a market decline. This typically leads to selling at the wrong time and waiting on the sidelines, forcing us to miss out on gains as the market recovers. But loss aversion can also make you act irrationally by holding on to the losers. When an investment we make drops, people might say that they'll sell once it breaks even, but there's no guarantee that it will. And if the investment continues to drop and we continue to hold, we're compounding a bad decision in the wrong direction. All while statistically, it's likely that a properly diversified portfolio would have increased in value. We tend to make decisions not based on what the optimal decision is moving forward, but based on what we've already put in, or its sunk cost. If we're holding a losing investment, especially if it's high risk and outside of our plan, it makes sense to sell and put those funds towards something we can have long-term certainty in. But we may continue holding the investment hoping it'll go up. And if someone else sold it for you, chances that you would buy it again at that price are near zero. We have a tough time making rational decisions for ourselves, but if that decision is made for us, it's easier to accept and see it as the correct one. It's often easier to give advice than it is to follow our own advice. Part of the reason why this is tough is because we tend to respond more positively to information that aligns with what we want to happen, especially if the information we want to hear points towards something good sooner than later. We prioritize instant gratification, so we are naturally inclined to prioritize the present. When we are hoping for something that will be very good and could happen very soon, it can leave very little room for reasoning. It's how we rationalize vague and sketchy opinions about an investment going to the moon. Rationally, it's unlikely to happen. But if we let our want for it to happen outweigh our rational thinking, it can cause us to make decisions that do far more harm than good. And we may find ourselves in a hole that we continue to dig deeper and deeper. Herd mentality refers to when we adopt the beliefs, behaviors, or attitudes of a group at the expense of our own judgment. We've seen examples of this when we discussed the history of market bubbles in Chapter 2, when people were trading valuable possessions for tulips, or buying a company's stock at ridiculously high prices because everyone else was. And we've seen this more recently with crypto and meme stocks. People didn't understand what they were buying, but they had a feeling that they didn't want to miss out on whatever was happening at the time. They mistook the immediate past as an accurate picture of the immediate future. Unfortunately, by feeling FOMO and giving into their misguided intuition, participating in the craze likely led to missing out on future opportunities for quite some time. When we jump into something without knowing what that something is, it rarely goes how we hope that it will. Our defaults can misguide us, and the truth is that they often do. We can mistake our belief for what we want to happen as truth for what will happen, but no one knows for sure what will happen, and we can easily accept this as truth for most areas in our lives. But investing seems to be not so clear-cut. A misguided belief can quickly become an overconfident certainty, at least in our minds, and can even more quickly become a disappointing reality. If you remember back to Chapter 2, you might recall that most active fund managers underperform their benchmark. And the same thing is true for investors. But in large, investors don't just underperform their benchmark, they underperform the exact fund that they invest in. A large reason for this is chasing performance. If we constantly jump from one hot-performing investment to another, we're constantly in a position of trying to compound at the peak of hot streaks. If we think that a hot streak is likely to be followed by a cold slump, then we're putting ourselves in a position where we can expect a loss in the short term, which, if this is our behavior, will likely be the trigger for us to find a new investment. With this pattern over a given period of time, everything we invested in could be looking at a gain, but because of our behavior, we could be looking at a loss. We think that we're putting ourselves in the best position possible to grow our investments, but we're actually putting ourselves in a great position to expect a loss. Many of the things that hinder our success as investors come down to misguided expectations and holding on to past decisions that no longer serve us. As investors, we'll be investing for the rest of our lives. We need to think in timelines that represent decades, not what we think might happen next week. All of these things are pretty obvious when we think about them outside of investing. We know not to jump off a cliff just because someone else does. My guess is the average person spends more time looking at coupons or for discount codes than they do about what they invest in. And if we grab a hot pan, we don't hold on hoping it'll cool off, we simply let go. We make a best decision looking forward, not looking back. We're far from being the perfect investor, and that's simply because we're human. But we all have a remarkable gift. We can learn, adapt, and get better at the things we want to improve on. And luckily for us, we don't need to be the perfect investor in order to have success. We just need to understand our own behavior and align it with what matters most. In The Psychology of Money, Morgan Housel wrote, "I can afford not to be the greatest investor in the world, but I can't afford to be a bad one."